Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know. First, Xiaomi's $7 billion 10-year chip strategy challenges Apple's dominance by rejecting the annual upgrade cycle. We'll analyse why this multi-billion-dollar gamble is a turning point and how it could affect competitive dynamics against Silicon Valley giants. Second, ex-Meta chief Nick Clegg warns the TikTok deal is a domino, sparking a global trend of data localization that fractures the open internet. This discussion will reveal how this trend connects to the US-China tech Cold War and what it means for the future of global platforms. Third, a former Weatherman's 140% trading gain lands him $3 million from a platform using algorithms to disrupt Wall Street's talent monopoly. We'll explore how this algorithmic scouting model could transform hedge fund recruitment and what new risk management challenges it creates for the industry. Fourth, 10 million YouTube TV subscribers face a blackout as Google and NBCUniversal clash over a double-dipping streaming strategy. We'll analyse why this standoff is a turning point for TV and how it could affect the competitive dynamics between tech giants and legacy media. Fifth, a new ETF democratises the private credit market but introduces liquidity mismatch risks that echo pre-2008 financial engineering. Today we'll take a closer look at this financial innovation and its implications for retail investors and systemic risk in the shadow banking system. A company just made a massive play to take on Apple, but their secret weapon isn't speed, it's a 10-year waiting game. Chinese tech giant Xiaomi is jumping into the brutal, high-stakes world of designing its own smartphone chips, a space dominated by Apple. Actually, designing a cutting-edge chip is one of the most expensive and difficult things a tech company can do. We're talking about mind-boggling complexity and astronomical costs. They've already launched their first advanced system on chip, the XR01, and are committing a staggering 50 billion yuan, that's $7 billion, over the next decade to the project. Now, this isn't the first time we've seen Xiaomi make an aggressive play. A while back, they went head-to-head with Samsung, building so-called affordable flagships by combining supply chain mastery with heavy R&D spending. But this move into custom silicon is a whole different ballgame. It's a direct shot at building the kind of top-tier brand perception that Apple has, where the name itself is the main feature. But here is the absolute bombshell. While Apple famously releases a new, more powerful chip every single year, like clockwork, a top Xiaomi executive just went on the record saying they won't be doing that. This is a huge deal and a massive strategic trade-off. By rejecting that annual upgrade cycle, Xiaomi is betting that it can make more ambitious, significant leaps in technology between generations. The risk, of course, is that in the years they don't release a new chip, their phones could look outdated. In fact, they can't promise a new chip each year. And if you think that's a lack of ambition, you'd be mistaken. It's all about one jaw-dropping number. The company revealed that to simply break even on a single chip design, they need to ship 10 million units. To put that number in perspective, research shows the design cost alone for a single high-end 3-nanometer chip, the kind of advanced tech they're using, is estimated to be between $580 and $590 million. That's before you even manufacture a single one. When you're spending over $500 million just to get the blueprint right, you can see why you need to sell millions of them just to get your money back. In comparison, their first chip is only shipping 1 million. This led to the most stunning admission from the executive. We know we probably need to have 10 years patience for the SoC to finally break even. 10 years. That's an eternity in the tech world. But that's not the whole picture. This is also a massive strategic hedge against geopolitics. Think about what happened to Huawei when it was hit with US sanctions and cut off from key chip technologies. That was a reactive crisis. Xiaomi is being proactive. By investing billions to control its own chip destiny, it's trying to insulate itself from being in that same vulnerable position years from now. So what about their current partners, the chip giants Qualcomm and MediaTek? So the thing is, managing multiple chip suppliers, including yourself, is a dangerous juggling act. We've seen this play out before with Samsung. For years, they sold phones with their own Exynos chips in some regions and Qualcomm Snapdragon chips in others. The problem was the Exynos versions were often seen as slower, leading to huge customer frustration. Xiaomi now faces that exact same risk of creating a two-tiered system. In a direct message to its partners, the executive said the company made it very clear to our partners, don't be too worried at all. Xiaomi is playing a long, dangerous and expensive game. It's a multi-billion-dollar gamble to achieve the holy grail of tech, perfect integration of its own hardware and software. And what's the real end game here? Their new SU7 electric car already gives us a clue. The infotainment system is powered by a high-end Qualcomm Snapdragon chip, and its autonomous driving brain uses two powerful NVIDIA chips. Right now, they're using other company silicon, but the goal is to eventually create their own scalable architecture, and everything chip that can power their phones, smart home devices, and cars, all under one unified system. This isn't a yearly race. It's a decade-long marathon for total control. Speaking of tech giants navigating geopolitical minefields, a former top executive at Meta has just issued a chilling warning. The dominoes are about to fall, and the open internet as we know it could start eroding. Sir Nick Clegg, who recently stepped down as Meta's global affairs chief, says people should feel uneasy about tech companies intervening in politics, arguing the two should keep a respectful distance. Here's where it gets interesting. Clegg's former job was literally to manage the intersection of tech and politics for Meta. Tech giants hire high-level former politicians like him in a strategy some call the rise of the tech diplomat, using their political capital to navigate regulation. So for the man who was arguably the world's most powerful tech lobbyist to now call for a respectful distance, well, it suggests the problems have become so intractable that even the experts are throwing up their hands. He points directly to the recent deal involving Donald Trump to keep TikTok alive in the US as a critical test case. We've been tracking this roller coaster for a while now, and Clegg's perspective adds a crucial new layer. The situation presents a fascinating duality. On one side, it's a corporate deal over an app, while on the other, it exposes the cloud itself as an invisible battleground for geopolitical control. The deal forces TikTok's US operations onto Oracle's cloud infrastructure, and countries are starting to weaponize this underlying tech stack to enforce digital borders. For instance, Europe is building its own sovereign cloud initiative called Gaia X, specifically to reduce dependency on foreign tech. Now, the national security debate has always boiled down to data and influence. Clegg zeroes in on this, saying the entire deal hinges on two key details: whether American data will truly be kept safe, and the ownership of TikTok's core algorithm, which he notes would be quite difficult to actually share. However, you could argue that separating the data from the algorithm is a false distinction. After all, recommendation algorithms are inherently political. They are shaped by human values and designed to influence our behavior, creating filter bubbles that can amplify polarization. The idea of a truly apolitical social media feed is incredibly complex and maybe not even technically possible. But this isn't just about TikTok. Clegg is sounding the alarm on a global trend called hard data localization, highlighting a recent effort by India to keep all data about its citizens inside the country. And believe it or not, the dominoes he's talking about are already falling. This isn't just India. We're seeing a patchwork of data sovereignty rules popping up everywhere, from the EU's GDPR to Brazil's own strict data laws. This forces multinational companies to build expensive, separate data centers, disrupting the economies of scale that made the global internet work. His warning is stark. The moment countries start doing that, the dominoes will start to fall. If every country demands their own slice of the data cake, the open data flows that power the internet will crumble. This all points to the core conflict, the relationship between the US and China. The real danger is that their fallout could push other major powers to pick a side. He calls the image of Indian Prime Minister Narendra Modi standing next to Chinese President Xi Jinping striking, concluding that if India starts emulating China and cuts itself off, it would be terrible for the global open principles the internet was founded on. From the complex world of global tech policy, let's turn to a story that's a bit closer to home about an individual who broke into another exclusive club, Wall Street. Now, get this. A former TV weatherman who used to point at storm systems on a green screen just got backed with $3 million to trade. Brian Lovin made the jump from meteorology to finance, but his bosses told him weather guys don't trade. So he started trading his own money, combining weather models with market data. The result? A staggering 140% gain in a single year. But a huge return isn't the only thing that matters. What these platforms really look for is how times you got there. They use sophisticated metrics like the Sharpe ratio to measure profit against risk. It's not just about winning big, it's about winning smart and consistently without taking wild bets. And he's not a one-off. A platform called FundSeeder is on a mission to find hidden trading talent around the globe. So how do they separate skill from pure luck? The platform has traders link their actual brokerage accounts directly. This allows an algorithm to analyze their real-time performance from risk-adjusted returns to the biggest dips their portfolio has taken, what's called a maximum drawdown. It's a way to get a verified tamper-proof track record. They've also seeded a derivatives trader in the UK with $10 million and even funded a dentist in Europe who trades markets on the side. I know what you're thinking. Giving millions of dollars to a dentist or a weatherman sounds incredibly risky, right? And it is. This is a huge challenge for them. Unlike a big firm like Citadel with a central team watching every move, this model is decentralized. This means they have to build new kinds of risk management systems to monitor these independent traders all over the world. The platform was co-founded by Jack Schwager, the legendary author of the Market Wizards book series, and they're launching a new accelerator program. Their mission is a direct shot at the financial establishment. A top executive put it bluntly, "We don't believe that Wall Street has a monopoly on the best traders." They call it a global casting call for the next top fund manager, designed to break the barriers that keep talented outsiders from getting in. It solves what one trader called the chicken and egg problem. You need money to raise money. It's important to add some context here, though. For every success story like the Weatherman, there are thousands of traders who apply and fail. This is a classic case of survivorship bias. We only hear about the winners, making it look much easier than it is. The real challenge for FundSeeder isn't just finding the winners, it's sifting through the noise to distinguish a true market wizard from someone on a lucky streak. By providing capital to unconventional talent, they're challenging the very idea of who gets to control the money, proving that the next market wizard could be anyone from anywhere. And as they expand, they face new hurdles, from complex international banking laws to strict compliance rules, proving that democratizing finance is as much a legal and operational challenge as it is a technological one. We were just talking about disrupting the old guards of finance. Well, speaking of disruptions, a high-stakes game of chicken is playing out between a streaming giant and a media behemoth. The story begins with a decision that could leave 10 million YouTube TV subscribers in the dark without Sunday Night Football, The Voice, and dozens of other channels. This isn't a one-off fight. You see, services like YouTube TV were supposed to be the saviors, the cheaper, more flexible alternative to traditional cable, but we're seeing them run into the exact same problems, rising prices and channel blackouts. It raises the question of whether these new internet-based TV services are just destined to become the new cable. So what's the fight about? According to YouTube TV, it's a jaw-dropping demand. They went on the record saying, quote, NBCUniversal is asking us to pay more than what they charge consumers for the same content on Peacock. In other words, they claim NBC is trying to make them pay a premium for shows that NBC sells for less on its own app. This is where the situation takes a more complex turn. It's a strategy some in the industry call double dipping. Legacy media companies like NBCUniversal are in a tough spot. They need to grow their own streaming app, Peacock, so they price it aggressively. But they also need the massive fees from distributors like YouTube TV. The risk is that by making Peacock so cheap, they cannibalize their own business, giving distributors a reason to say, why should we pay you so much when you're undercutting us? But NBCUniversal is firing back, claiming YouTube TV is the one playing hardball, alleging that they've, quote, refused the best rates and terms in the market, demanding preferential treatment. And this isn't just another corporate squabble. What really brought this to a head was a public statement from NBCUniversal claiming they have never, not once, gone dark in their history in the US. This isn't just a negotiation. It's a potential first for one of the biggest names in media, and they've already started running on-air alerts to customers about the impending blackout. If a deal isn't reached by the September 30th deadline, the channels disappear. YouTube TV has pledged to offer subscribers a $10 credit if that happens. Now, this credit is more than just a refund. It's a sophisticated PR move. In the old days of cable disputes, customers were just left in the dark. By proactively offering a credit, YouTube TV is trying to win the court of public opinion, positioning itself as the consumer's champion. But the real story is the massive power struggle. This is a clear sign of YouTube's newfound muscle in the television world. This isn't just about channel fees. It's a proxy war between Google, which owns YouTube, and Comcast, which owns NBCUniversal. They are fighting for the future of television, advertising, user data, and control of the connected living room. Research shows YouTube is already a powerhouse, earning over $31 billion in ad revenue last year, with 150 million Americans watching on their TVs every month. And that newfound muscle we mentioned, it's very real, and it revolves around sports, specifically Sunday Night Football. YouTube TV recently spent billions to acquire the rights to the NFL Sunday Ticket. This gives them immense leverage. They are no longer just another channel provider. They are a major destination for the most valuable content on television. This fight is a signal that Google is ready to play hardball to dominate the future of TV. That fight between Google and Comcast is all about massive revenue streams. That reminds me of another corner of the financial world where big money is being made, but one that's been locked away from most of us until now. A new survey of financial advisors just revealed something unexpected. They're more interested in a little-known asset class than they are in Bitcoin. That asset is private credit. For years, it's been the exclusive playground of institutional investors and the ultra-wealthy. So what is private credit exactly? When mid-sized companies need a loan, they don't always go to a big bank. Instead, they turn to specialized investment funds that lend them money directly. It's a huge part of the financial system, often called shadow banking, and because these loans are private and not traded on a public market, access has been restricted. The big draw is the potential for, quote, low to even high, double-digit type income. And those high returns come from the fact that these loans are often riskier and less liquid than traditional corporate bonds. Lenders demand higher interest rates to compensate for that risk. Plus, many of these loans have floating rates, so as interest rates go up, so do the payments to the lenders. Now, two firms, Simplify Asset Management and Verify, are cracking that door wide open. They've just launched a new actively managed fund, the Simplify Verify Private Credit Strategy ETF, ticker symbol PCR, but its strategy is completely different. It provides indirect exposure by investing in what are known as business development companies, or BDCs, and closed-end funds. Let me break that down. BDCs are basically publicly traded companies whose whole business is lending to private businesses. So this new ETF isn't holding the private loans directly, it's holding shares of the companies that do. However, if you zoom out, you'll see a potential issue that experts call a liquidity mismatch. The ETF is marketed as a liquid vehicle, meaning you can buy and sell it easily, but it invests in BDCs whose actual assets, the private loans, are highly illiquid. The big question is, what happens in a market panic if everyone tries to sell their ETF shares at once? The ETF might be forced to dump its BDC shares, potentially triggering a fire sale that could cascade through the sector. This all circles back to that survey. Verify's head of research, Todd Rosenbluth, said more advisors chose private credit over digital assets when asked how they were looking to diversify. This shift by advisors isn't just a random preference, it's a strategic one. For one, private credit has shown incredibly consistent returns with a very low correlation to the stock market. One analysis put it at just 0.39. This means when stocks go down, private credit doesn't necessarily follow. Advisors see it as a stable income generator, not a speculative bet like crypto. The bottom line is a massive shift is underway. An asset class once guarded by Wall Street's gatekeepers is now being packaged and delivered to retail investors. But changing who gets access brings with it some serious questions. Interestingly enough, some experts are drawing parallels to the years before 2008. Back then, complex mortgage products were packaged into things called CDOs and sold to a wide audience. This new ETF is essentially packaging up the shadow banking system for everyday investors. It democratizes access, but it might also democratize risk, raising new challenges for consumer protection that we all need to watch.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.